in him, Venkatesh and the team, they can make this an annual event, not more for the sake of dissemination of great knowledge, experience and things like that, but the fact that a good number of you here happen to be alumni of the academy, and the way he is structured is that almost all of the speakers right from the morning happen to be alumni of the academy. And for me, having going through a phase of every day graying more, losing more hair, adding more, so as I go through that process, I keep seeing people achieve so much of reaching so great heights. You saw Wipro CFO, you saw Narayana Health CFO. They came in the morning, no? They didn't turn up. Huh? She didn't turn up. Sandhya came? Sandhya didn't come. Okay. Okay, they have all become so busy, you know. I know from an executive role, it's so very difficult to come. But I'm sure one suggestion at Patabi, probably next time we should plan it on a Saturday so that employees like us, you know, not like you, like me, not us. So employees like me can manage our calendars a little better. So I just hope that alone. But thank you, Patabi, for putting this together so well. I just want to start with one promise to all of you that while the topic I'm supposed to speak is on future of financial reporting, I promise you I will try my best not to use or talk anything about ESG. You should smile. I'm not going to speak anything about sustainability. You should smile further. I'll not speak anything about data analytics, technology, use of technology for reporting and all of that stuff. At least personally for me, over the last few years, every time people talk about financial reporting, they speak only about all of these elements, and probably the hardcore of financial reporting probably has lost some touch somewhere. So I'll broadly share my thoughts within the next 20 minutes in 3 segments. Part A, I'll share on core financial reporting. What are the developments which are there? I see good number of you coming from reasonably large organizations to whom Ind AS is applicable. And when I came here prepared, I thought the audience was going to be largely industry people, but I realized during the break that some of you are from practice. So let me see if I can tweak a little, but pardon me if my conversation is largely industry oriented, because I got carried away by the topic that finance is basically for industry guys. Part B, I'll spend a little bit on auditing, some important developments which the auditee, that is the preparers, need to be familiar with. And lastly, I'll share some experience of the way regulators are looking at the future of finance and how we as industry, we as preparers need to gear ourselves for this. So 3 parts. So part A, beginning with financial reporting, changes in financial reporting. We will see a very transformational financial reporting coming up, effective January 2027 globally, and in India from April 2027, which is IAS 1 will be replaced by IFRS 18, which is nothing but our Ind AS 101 which we have. Ind AS 1 which we have will get replaced by IFRS with Ind AS 118. And if you are thinking 2027 is too far off, it's not too far off. 24 is already over, less than 2 years for you to actually look at the way you start collating the data and start looking at how these financial statements will be drawn up. So primary financial statements, that as equivalent of operation, most likely and not most likely, it will hit the road from January 27 internationally, and in India from April 27. The income statement will take a format which will be reasonably closer to the cash flow statement. So if you look at cash flow statement, and my experience, investors, analysts, equity research analysts, they tend to give more weightage to cash flow statement because of the clarity it gives in terms of how earnings and spend is happening. The same kind of thing will happen for income statement as well. So in the income statement, the template will now appear as, the income statement will appear as, the first segment you will have operating net income, operating profit. You'll have gross profit as a subtotal. Operating cash flow definition which you have in cash flow statement, there's some marginal difference, but they're more or less comparable. So your income statement will give the user of financial statement very clearly that for all the 365 days of work which has been done, this is the operating profit which has been generated, and this is the profit which is more or less recurring in nature. The next segment will be investment or investing related cash flows you get from associates, from joint ventures, dividend income, etc. So all of that will come as second part, which is what we call as investing portion of the income statement. The third part will be the financing portion. So you get cash and cash equivalents, some interest income, etc. you earn, and there is interest expense outflow, term loans, working capital interest, etc. That will be the third element, and then you have the PBT followed by the PAT. So that's how the entire income statement is getting drafted. It is truly transformational, and since Suri is there, for insurance companies, the template undergoes a little change where you can see insurance business profit separately, investment income profit separately. So that format is also been made part and parcel of IFRS 18. The good thing about IFRS 18 is it recognizes that each industry, each sector would have its own ways of looking at operating performance. So it allows the preparer, the entity concerned, to give additionally from whatever is there in income statement, additionally what we call as management performance measures. Says, yes, go ahead, but you need to give a reconciliation between that EBITDA which you call as EBITDA with the line item which is there in the income statement, which is the nearest line item. So nearest line item here will be operating profit. So you have to give a reconciliation between EBITDA as you consider it as a relevant management performance measure with the operating profit. So you can add 1 or 2, 3 own management performance measures and repeat it. The next element which comes as part of this is what we call as unusual items of income and expense. So this exceptional items and all will go away. So instead you have this separate animal called unusual items of income and expense. The idea is everything which is non-recurring in nature, and to enable predictability, you remove unusual, rest of it is supposed to recur in future. Everything remaining. There are always some acquisitions happening, inorganic activity happening. So whenever you have this inorganic activity happening, the shareholders' interest is affected. So you acquire an entity which adds to 20% of your balance sheet size, 15% of your income statement size, whatever, and there are some assumptions or some basic basis which is there for that particular inorganic activity. So what IFRS 3, Ind AS 103 will require is, for the future, for a minimum period of 3 years, you will have to give as part of your financial statements the rationale for acquisition, assumptions which you had at the time of acquisition, and where do you stand on the same. So you're required to make a disclosure of the reasons for acquisition, the underlying assumptions. The assumptions, I thought I'll increase my market share by 4%. So did I increase by 4% or 3.2 or is it 4.5? So that part of disclosures need to be done so that the users tend to get much better information of the company's activities. Similarly, on impairment of goodwill, some bit of simplification has also been done. Financial reporting is concerned, particularly for Ind AS entities, and for AS entities you have to wait a little longer. So Ind AS entities, there are many cases where there's a parent and they have subsidiaries, 1, 2, 3, 4, 5 subsidiaries, and company like L&T, I think they have a few hundred subsidiaries. So you have so many subsidiaries which are special purpose, whatever entities they are. Now these entities eventually get consolidated with the parent. So what it says is, if they're wholly owned subsidiaries. For the subsidiaries, you don't need to give the same level of disclosures as a consolidated financial statement or normally what you would do for a standalone financial statement, because subsidiary in substance, particularly when it's a wholly owned subsidiary, it's part of the parent, that's only one shareholder. No need to make a huge amount of disclosures for those individual subsidiary financial statements. So that's another change which is happening as concern. Then apart from this, for those of us who are familiar with the accounting standards framework, in India as we speak now, we have two frameworks. One is the Ind AS framework and accounting standards framework. The accounting standards framework is now going through a revision, and once the revision is completed, they have identified 32 standards. All of us, as we are familiar with up to AS 29 minus 2-3 standards, effectively 26, but that 26 is going to become 32, and these 32 standards will be brought closer to Ind AS. The idea is for entities when they move from a non-Ind AS framework to Ind AS framework, you shouldn't have too much of transition difficulties, and what is revenue in one framework has to be revenue in another framework. You can't have a different definition of revenue. What you can compromise is the extent of disclosures. But revenue, whether it is AS framework or Ind AS framework, it has to be same. Expense has to be same, asset has to be same. What you can have different is the extent of disclosures. So subject to that broad guidance, the accounting standards framework is getting revised. Hopefully, the institute will make it applicable after Ind AS is made applicable to banks and insurance companies. They want to give a 1-year window and then make this new framework available. So these are broadly some of the developments as far as financial reporting for the next 3 or 4 years is concerned. Now, the next part which I'd like to talk while in the context of financial reporting is what you will not witness in the next 3-4 years. What I spoke till now is the tangible known developments for next 3-4 years, but there's a lot of work happening on some changes which will come in the future. If you look at the evolution of financial statements, when I still cost, so incurred cost whenever, capture cost, and that cost continued to be carried in the financial statements. Now with Ind AS or IFRS, we now have fair value as a basis. So fair value is nothing but today's value. Today if I exit, what will I get? But fair value, we don't use it for all items in financial statements. Fair value, if you look at Ind AS financial statements, fixed assets, property, plant, equipment, all of us invariably carry it only at historical cost, even though the standard allows to follow a revaluation model. The same applies to intangible assets, inventory, so on and so forth. Even in the case of investments, we have a category called amortized cost category. We still carry it at cost. So if you look at even now, good number of items in financial statements continue to be in historical cost, but we have moved a step further where there is some amount of fair value which is there. But look at it from a user's perspective. For a user of financial statement, whether it's an investor or lender, whoever it is, historical cost is an irrelevant number. So I bought a parcel of land 30 years back, historical cost 10 lakhs, today's market value 30 crores. This 10 lakh number reported in financial statement is an irrelevant number to a user of financial statement. For you and me as preparer and as auditor, it's convenient to carry 10 lakh number because it's a proven number. But the 20 crore fair value is a number which involves judgment, estimation, and the risk of some volatility and all that kind of stuff. But look at it from user's point of view. For user, historical cost of 10 lakhs is a completely irrelevant number. He wants to know today what is the worth of the assets which you are carrying. And what happens invariably is the principal shareholders and the management team, they have an idea of the composition of their assets, the likely value of the assets, information and all. So there is an information arbitrage between one category of shareholders, the principal shareholder, the management who have shares in the form of ESOP or whatever form, and the rest of public at large. There is that information arbitrage. And what we all need to recognize is the fact that we will all start witnessing significant amount of retail participation or institutional shareholder participation in the companies. Today already we have the SEBI mandate of minimum 25%, but as markets develop, if we were to look at markets like US, Europe and all, markets develop, unless the free float is high, it is 30, 40, 50, 60%, you will not get the valuations like what Google gets or Microsoft gets or what Nvidia gets or what, for that matter, L&T or ITC get, because they all get good valuations because it is entirely held by a large set of shareholders and not concentrated with a few people. So because of which there's so much of liquidity and depth in the stock, and as time goes by, you will all find that there will be substantial amount of risk capital, retail, either directly or through mutual funds, and all of us have seen the SIPs and mutual funds, how much of money has been lapped up in the last few years. There's so much of money from retail investors which have come through mutual funds into company stocks and all. There are institutional investors who are actually holding the money of large family offices and large high net worth individuals. That money is coming there. And even if you take the unlisted companies, the private equity funds, alternate investment funds, all of these are monies from family offices and high net worth individuals. Effectively, lots of public money is chasing. So as more and more of public money keeps coming into business in whatever form, listing, unlisted, whatever form it comes, the need for information will also increase, and the arbitrage of information between one set of people knowing more and the others will also shrink. So that arbitrage will also eventually go away. So what steps will happen in the direction? Time will tell, but there will be efforts happening in the direction, and I'm witnessing the same. Now, what is important for all of us to realize is, don't get me wrong, I'll speak candidly, we can agree to disagree, Whether I was in my term in industry, when I was in Sundaram Finance, preparing for auditors, like what Sriram does now in my company, I used to do exactly the same job of handling my auditors. Or when I was in practice for about 8-9 years, auditing companies. Or now, in my company, and I know my guys also do the same behavior, general tendency of most of us as finance people is to keep the information like this. We don't like to share it. We don't like to share it with even a peer department in the organization, cross-functionally, auditors, etc. Somehow that DNA is there. I've tried my best to change, but somehow not much of success. They still appear to be sharing, but they don't share. They try to keep it very, very close. But those days are all gone. You have to be mentally prepared that we've all come to an era of open stack. And in this era, information has to be necessarily made available. You can't then tell the CEO a surprise that, look, there is extra profit. Those days are all gone. If you go and tell there is this extra profit, he'll slap it, say that I didn't sleep last 10 days because you held back this profit. So what is the cost of my sleep? So those days are all gone. But the bottom line I'm trying to say is that all of us as finance professionals need to get prepared to an era of making available information rather than holding information. And the information we need to give is what we call predictive information. So Venkatesh was talking about his 12th standard child. He himself looks like a child, but it also says that he has a 12th standard kid and all. So he talks about only a kid with AI knowledge accountant will survive, like that. Today, as far as the finance professionals are concerned, I want you all to take this example from your personal life. All stakeholders, whether it is investors, bankers, your own colleagues in the company, all of them will ask for predictable information. Historical information, they already know. What is there now, either they already know or they'll get to know. But what they want to know for decision making and acting is predictive information. And there is this demand from a large set of investor community that how can you evolve financial reporting to make available predictive information. I don't know how many of you can recall, we have this accounting standard 1 or IAS 1 also, which says objective of financial reporting, two things. One, understanding the past. Second is extrapolating to future. Historically, all of us have been focused on understanding the past, but I think this objective of extrapolating future has been well set way back 1977 itself, but probably it took its own 40, 50 years time before it can actually be put into practice. The point is, as far as financial reporting is concerned, we all need to develop abilities. I don't know how, but we all need to develop abilities where we can make available information which is predictable. I'll just give a very simple example to connect. Let's assume, I saw some of you come from Bangalore and all. You want to either catch the flight in the evening or go to the station and catch the train. You know the distance from here to airport is 5 kilometers. But what is important for you is, if I leave this hall at 5:30, how much time it will take for me to reach the airport? 5 kilometers historical information I know. That is no value to me. What is value to me is, if I leave at 5:30, will I reach in 25 minutes? Will I reach in 35 minutes? That's the information. If that is the information all of you want, then look at the investor who has put his hard-earned risk capital. He has exactly the same requirement of predictive information. Look at weather information also. All of us look at weather. We say, tomorrow what is the weather? I am planning to travel to Europe next week. I want to know what is the weather likely to be in Europe next week. I look at the map. So that's how you look at it. The same as far as financial reporting is also concerned, and all of us need to gear up for the same. Now, part B, and I'll conclude in the next few minutes. Part B on auditing. I'll just leave one important point, which is common for both industry and auditor and auditee. Currently, most organizations, as I've known, the audit engagements with audit committee boards are reasonable, but those days are going to change, and there will be a requirement of what is called audit quality indicators. Matured economies, audit quality indicators have already become a reality. I'll briefly explain what it is. Take, for example, as an employee, I am an employee of my company. Between me and my boss, we agree at beginning of the year and quarterly, every quarter, we agree that these are the 5 areas and these are 5 into 2, 10 indicators on which my performance will be measured, and based on which I consecutively get only B rating. I've never got a A rating. Now, whereas when it comes to auditor-auditee engagement also, auditee is almost like an employee for you, is a service provider to you. So between audit committee and auditor, at beginning of the year, you are required to agree on what are the audit quality indicators, like partner time, 30 hours a year, audit engagement team, so many people with so much experience, and so much time. So you agree upon this, and so much L&D hours. So you agree on what are all the audit quality indicators, completing it 2 days before, giving the audit committee presentation 24 hours before. You agree on what are all the audit quality indicators, and at end of each year, you review and say that, look, your performance has been good, not good, can be better, and next year again you review. And that will become the basis for continuance of the audit engagement and all. So that will be a reality which will hit India. Initially, it will start very soft with voluntary practices. Max 3-4 years, it will become mandatory requirement. And I would strongly encourage all of you working in good companies and all, start this proactively itself, and you'll find that both the auditor and auditee will tend to benefit from this practice. Now let me come to the last part on regulatory and then conclude. Just take 2 minutes extra. Regulatory part. As far as regulatory part is concerned, all of you are aware that NFR has come to stay. Institute has done a good job, QRB, FRRB, all that stuff. NFR does exactly the same thing. The difference between the two is, when Institute did this work, it used to be low decibel. Only the review firm knows that this was done, and with that it was over. But now with NFRA, situation is different. If the review is completed, NFRA puts it on the website, it gets published, and the whole world comes to know of the same. And it's just an indication of the changing times. And if you look at even our own personal behavioral aspects, if we don't find somebody in social media for 2-3 days, or no WhatsApp coming for 2-3 days, you suddenly start doubting, is this person still there, You start doubting. So you have come to that stage where regulator has to make themselves say that, yes, I am there, yes, I am there, yes, I am there. And the trend of regulators continuously publishing information, keeping themselves in the limelight, that trend is now on. And I want all of you to be conscious that the current NFRA leadership, the chairman is Mr. Ajay Bhushan Pandey. He was former finance secretary, almost the number 2 in the government. Electrical engineer, there's a reason why I'm telling you this. Electrical engineer, civil servant, career bureaucrat. And he's been the father figure and the mentor and the executor of UDAI. The entire Aadhaar project was led by him. Digital transformation. Entire GST and network is again digital transformation, was led by him. The point I'm leaving for all of you is that person of that profile is heading NFRA now. So his ability to think technology and apply it for audit reviews and to reach out to the people in terms of compliance, etc., and punish is much higher. So the days have changed. Still early days, they're still engaged in a developmental mindset. But 3-4 years from now, it will be quite different. So I think it's important when you talk about the future, you are aware about how the regulators are looking at it. Same is true with SEBI and the other regulators as well. So you can all expect regulators to be in a very hyperactive mode. And while on this, I'll just conclude with this last observation. All of us strongly believe 3 trillion to 5, 7, 10, all of it to happen pretty fast. All of us know it will happen. 5 will happen, 7 will happen, 10 will happen, and all of it will happen in our own lifetime. For me, when I started, we were less than a trillion, and 1 to 3 took a long period of time. But 3 to 5, 7, 10 is not going to take long period of time. And when you are going to drive at that speed, accidents are bound to happen. Accidents are bound to happen for the organizations you are part of, and there can be collateral damage also. So when one person goes and hits, that vehicle can come and hit your vehicle which you are very innocently driving on the side, and you can also become impacted. The same will happen here as well. So while this economic growth happens at a very fast pace, you all need to ensure that you have very high governance standards and reporting standards for you to travel through this journey of high economic growth. If your internal practices are not strong, it is very difficult to ride this high speeds growth, and look at it. 3 to 5 to 7 is not a small growth, it's a phenomenal growth. And that kind of growth will happen. All of us will be beneficiaries. But it's important that as people, all of us holding very responsible positions and compliance positions, KMP kind of positions, auditor positions, we should not become a victim of those accidents, either while driving or as a collateral. So you need to keep that in mind as you prepare for this future of financial reporting. So thank you all for your patient listening. Thanks Patabi for the opportunity to be here, and best wishes to all of you.